Hi, can you hear me? Hi, I'm Christian Czernich, and I'm okay. I'm Christian Czernich, and I'm running a royalty fund for software firms in Europe. We are located in Vienna in Austria and in Stockholm in Sweden, and we are pioneering to build up a credit market for tech firms in Europe. The market for credit in tech is really underdeveloped in Europe, and it's just starting to emerge. And we started a couple of years ago to test and see whether it could work to use royalty financing to fund software companies. Back in 2017, when we started with that, nobody was really understanding what we were doing, but we were very convinced that the market would go in that direction. We've seen that in the US, that there's a lot of revenue-based lending out there in the market, and of course also in the pharma space and in the mining space. It's a model that has been established for decades. And we just thought that the cash flows in the software industry are very similar to the cash flows in the pharma industry. You have no operating, so that the cash conversion is extremely high. There's high operating margins. They typically have negative working capital, and there is no capex. So it's quite easy for those companies to give a share of their revenues in exchange for funding. Of course, the big advantage for the firms is that they are that the funding is non-dilutive, and we have been doing this now for a couple of years, and now the market is really picking off. We see that a lot of entrepreneurs in Europe start to think not only equity but also debt when they think about how they can fund their growth, and so that's really a great opportunity, and we are there in this market.
I thought it's an interesting strategy because it's a way to play venture safer. You don't think of Europe as a source of innovation, but a source of a value play, which and when you do venture debt in the U.S., a lot of times you're betting on the funds, and there'll be follows, and these guys they're not going to let this baby die, whereas you're playing it on fundamentals. And so it's an interesting way to play venture with the debt side and have access to Europe. So I'm intrigued. Now, having said that, I see, someone was saying, I think it was Roberta, the valuations that are out there in the U.S. markets, including bulge bracket private equity, is pretty insane in some ways. But part of it, Steve likes his world here, that's, but with that said, Craig, your fund, if you can come off mute, is in the lower middle market, and you've developed a nice track record here in the U.S. North America. So if you could just sort of show your perspective from the lower middle market private equity world. One second. I don't know if you're muted or we've muted you. 1 second, Craig. Go. Floor is yours.
Mark, can you hear me?
Yes, go for it.
Okay, great. As a quick introduction, I'm Craig Edenstein, based in Los Angeles. I trained in Bain under Mike Milken in his private buyout organization. I run Corridor Capital. We're a lower middle market operation and transformational private equity firm backed by institutional and family office limited partners. Purchase little leaders, not yet institutionalized, buying around 5.1 times EBITDA, build infrastructure, scale and sell for about 10.1 times EBITDA. My view of the lower middle market is that the world has over time commoditized, and that the generalist financial engineering private equity business is a tough one to run today. We're now in the age of specialization, and different kinds of models we see in the small market would be those of a deep sector focus, such as healthcare or industrial services, those with situational expertise, such as distressed or corporate carve-out models, people with transformational operational engagement models, which would be a solutions-oriented approach to adding value. A really interesting firm is one that does technology implementation, which would be Bertrand Labs, as an example. Infrastructure institutionalization, which is a two-stage ownership model, where you invest in leadership businesses that haven't yet scaled because they lack certain infrastructure. You build out that sustainable, scalable architecture, and then you take them through scaling. That's what we do. There are those with consolidation models, like Audax and CI partners, who are really phenomenal at building out that capability. And then lastly, the other thing we see in the market are folks trying to differentiate by serving underserved markets, such as underrepresented minority targeted categories or business managers, or in our case, women-run businesses. About 40% of our CEOs are women, which is a market that is grossly underserved by private equity. So in summary, what we're seeing is folks trying to, over time, put a lot more specialization in and around their business models to pick a lane, and even within that lane, pick even deeper subspecialization in order to be able to buy right, add sufficient value to defend on a risk-adjusted basis their assets, and ultimately exit with appropriate returns for the asset class, which I would argue for the small end of the market need to really be a mid-20s type of net IRR to investors.
Great. Thanks, Craig. We'll have it's time for a question. We've had a long discussion of the importance of liquidity, and then the public versus private, and then some of the FANG stocks versus small caps. Fortunately for 85, actually probably more like 105 weeks in a row, we've had Stephen Burke. So he always says, why are they investing? They're so enamored with these private alternative funds and investments. So make the case for the publics, either U.S. equities versus vis-a-vis private, not necessarily emerging markets. That's a different discussion.
Okay. I think the world is, as Greg pointed out, in the emerging markets, there's not any one market anymore. So I think you're investing in ideas, whether it's public or private, shouldn't matter as much until you need liquidity. And we never really think about liquidity, usually until it's too late. And we've had that as our experience in this industry forever. So I think you want to balance your portfolios with the ideas that are the ones that are going to attract capital, obviously, but you also want to have your portfolio blended to allow for the liquidity that comes. And I think sometimes we forget, what are the public markets are for the last 10 years have done about 16% annual return. It's not what you get in venture deals or other deals, but there is a consistency to it that is pretty attractive, and we've all benefited from the low interest rates. I think one of the worries when the punch bowl's pulled, we're going to have some real valuation issues, and I think you want to make sure your liquidity is set up to accommodate that. And in a lot of the discussions I hear from families, I'm not sure the enthusiasm for the less liquid stuff is balanced to what the liquidity needs will be over time. We're all chasing the same ideas, the same themes that are going to drive where capital is going to flow. Public-private venture really doesn't matter. Debt or equity shouldn't matter as much. These are the areas that are going to drive the economy forward. We're going through massive transformations globally, and you want to have a piece across all. And we think that the other thing that's important about the public markets is there's massive capital creation going on there. And just to give you a sense, I mentioned this at the 11 o'clock session, but 9 companies in the S&P have moved from 2013 of a market cap of $1.2 trillion to $13 trillion. That's the FANGs plus Netflix and NVIDIA and the like, Tesla as well. So you're seeing a handful of companies driving it, but they're also bringing a lot of companies along with it, both public and private, creating new opportunities. So I think we just have to keep an open mind to it. And what I would say in the public space is, I don't think indexing, because of some of the valuation issues, is where you want to go right now. I think you want to do the same thing you're doing in your private portfolio and your public portfolio, which is identify the opportunities, focus on them, and go after them. And I think that's the way you would play it in this environment. And what I would worry about is whenever the rate regime changes, and it could be sudden, that's when you're going to be concerned about your liquidity needs. And that's when you'll know, as Buffett says, who's swimming naked when the tide goes out. So we just want to keep balanced in what we're doing.
Fair enough. Is there one more perspective that Ivana Park could come up, is growth equity. So we've had venture debt, opportunistic equity, we've had the publics, and we've had the lower middle market. Actually, Eddie, if you could come right over here. You can talk about Europe if you want to. It's a little hot. So tell us about why should we be in, venture equity?
So particularly in the light of impact, by the way, which obviously this should be and is an impact conference. So I'll answer that question in that light. And Stephen just mentioned there are massive transformations going on across the globe, particularly in tech. And tech, we feel our thesis is enabling growth for the rest of the planet for the next decades to come. So that's what we invest in, and arguably the most important stage of that is nascent companies with nascent technologies. We just had COP26 and with a lot of negotiations there. You can say it's successful or not successful, but all those investments and all that CO2 reduction is based on the premise that technology will figure out a way in which we can better and more cheaply sort of reduce CO2 from our lives, which is obviously a massive challenge. That starts typically with small companies. Health, for example, same thing. A lot of the future growth in that sector will be done by companies that are right now coming out of the PowerPoint presentations of young entrepreneurs. Blockchain, same thing. The average CEO in the blockchain space is probably 24. I mean, that's maybe a high estimate. It's young nascent industries that are poised to grow and that are solving real issues that are there or that will be there. We believe this is the time to invest in venture. That's essentially it. There's a big difference in late stage venture and in growth venture. Okay. In growth venture, you see valuations in growth venture coming earlier and earlier on. That's one of the challenges we have. Some people think they're worth 100 million when there's an sure. 8 slide PowerPoint presentation. But
I thought that was Canada. Okay.
That's a challenge. But at the same time, there's a lot of those companies that sure. will, in 10 years, dominate the NASDAQ.
Well, you're sitting right next to another fellow European, Austrian, Stockholm. You were in Leiden. I studied in Leiden. We love Europe, right? Maybe talk for a second. The European opportunities. Where are the best opportunities? Is it debt or equity?
Well, I mean, of course, the equity market is always interesting because as long as digitization goes on and we are just in the first quarter of the whole process, of course, equity is interesting, no doubt about that. I'm just always a little bit worried about the valuations. Right now, the interest rates are really low, and the inflation is going up a lot. And I don't think that we see the real inflation rate that is going on at the moment, and we don't know it might rise. So interest rates might rise, and then of course that has a detrimental effect on the valuation. So that would be my only concern. But otherwise, of course, equity is extremely important in Europe, and the debt market is interesting because it's just emerging. So we are much earlier in the cycle than in the equity market, and there's a huge opportunity to build like a massive firm or massive firms providing debt to European tech companies, and that's the opportunity that my firm Round 2 Capital is pursuing, and I think that's interesting. We have a protection against inflation. We have a protection against potential decreases of valuation. But yeah, and Germany, just to finish off on the story in Europe, I mean, Germany is of course at the heart of Europe, and they have been quite slow on digitization, but I would not, I would bet on Germany quite a lot because they are awakening now. There's a new government coming in, and they will massively invest in digitization. The same for France. Actually, France is also really, really interesting, I would say.
And by the way, we'll be back in Europe. We're worried about what's happening in Austria right now, but we'll be there. Maybe Craig, what do you think? Lower middle market private equity versus growth equity that Eddie's investing in, or both?
Well, so I'm a former Forbes 400 family CIO, and to me, it's about asset allocation. At the end of the day, you're building a series of investments in the alternative space. I wouldn't pick one or the other. To me, you're building an allocation, and the allocation in a perfect world is engaged in selecting what I'll think of as value-added strategies, regardless of whether they're real estate strategies, growth strategies, private equity strategies, distress strategies, et cetera, because ultimately I think we're in a time where the nature of the interest rate environment and some of the economic dynamics of coming off of this completely unprecedented extended expansion means that you have to be in places where people can buy things a little bit more intelligently and then use various tools to maximize risk-adjusted returns. I think growth is a fantastic place to put capital. There's very fundamental and recorded systemic changes that are happening in the underlying way that we do business, the way that we live. I serve on the board of Naspers and Prosus. We're one of the largest investors in the internet in the world, across both emerging and developed markets. And there's so many places to pick in growth, but to me it's about being targeted and ultimately backing individuals and groups that have differentiated access to deal flow, as well as skills to make a difference in those assets within the growth strategy. And then within private equity, I would say the same, is you ultimately have to curate manager selection where people have a competency to really prevent the inherent risk of material downside that's going to come from the volatility that we're going to continue to see, and frankly, I think, see more of in the markets ahead. So I think it's a both answer, Mark, and I think it's really about curation of finding the value add elements and the preferred access and ability to make a difference in businesses within manager selection.
Luscious Cendric. So questions on asset classes? Yes, Jaspreet.
It's related but not really in asset classes. Thank you, Mark. This is a question for all of you. Almost every panel I've ever attended related to investments or emerging markets, there's always a comment that we want to support more women founders because there aren't enough women as CEOs or founders. But I've been hearing this for a long, long time. I'd love to hear your opinion. Is it because is it a deal flow issue? Is it a deal quality issue? Is it a deal confidence issue? Why is the number so low?
So I think it's a question that crosses all markets. It's not unique to emerging markets. It's all markets. I think it starts with who has the bulk of the capital. You have a bunch of white men, predominantly, who have the bulk of the capital, and when you ask those folks to design a risk-adjusted portfolio, they commonly are going to find people that look a heck of a lot like themselves. And that might be academic pedigree, it might be history of their activities in their life, or whatever their preferences or priorities are. There's a lot of like for like that happens in the world, and it creates a very challenging model for people to break through. And so in a perfect world, people think of it as an underserved market. And I mentioned in some of my comments earlier, and if you think about it from just a pure capitalism perspective, the reality is, if you think about a woman CEO and you place her side by side with a male CEO, the woman CEO on average had a lot more challenge to get into her position than the equivalent man. And by definition, if you just think about it mathematically in a very agnostic way, by definition, for her to have gotten to that position, more likely than not, she's superior to her average male counterpart. Yet, capital doesn't seem to tell that story. In venture capital, we see about 3% of the dollars going to women-founded teams, or teams that include women founders. If you look in private equity, the number's closer to 7 across. Oliver Wyman did a study very recently that looks across Europe and developing markets.
Craig, can I just,
the U.S.
sorry to interrupt, but maybe Hema could speak to that because she has a fund dedicated to this thesis.
Sure.
And explain what, Hema, explain what 535, what's behind that.
Sorry?
If you could explain the name of your fund.
Sure. Yeah, so, just first to reiterate what Craig said, I think spot on, right? Until there are more people who look and sound like me at the investor decision-making tables who are allocating capital, no one's going to point money my way, right? This is my lived experience, and we can dig deeper there. But the second part of it, so all the reasons you spoke about, the unconscious bias, where the money is coming from, those are that's well-versed, and we see that. But I think we don't talk about two things. One is the opportunity, right? We have to separate this. Everyone thinks about gender and underrepresented founders as only impact, So of course there's impact, but if people are only looking at it through an impact lens, of course, people invest into funds because they want to make money. There's money to be made, returns. And, I have a compound with a female, Africa and the like, and it seemed like a charity case a little bit, right? So whatever I have left over, I will then allocate to women or underrepresented founders. And until we change the narrative about where the money is going, I don't think it's going to get there fast enough. And that takes me to the opportunity. So my fund is called 535 Ventures, and it's just that. We know if we add more women entrepreneurs to the African ecosystem, we could see up to a 5% GDP uplift. And that's actually largely wholly true globally as well. That's 2 to 6% globally. And that's really by leveraging the 35% higher ROI that you typically see in diverse teams over all male-led teams if the playing field was level. So if they had access to the same resources, capacity, networks, and the like. There's study after study being published about, and I think Craig, you mentioned this as well, how women generally perform better. I don't have the luxury of winging it, right? I have to be credentialed. I have to prove my track record 5 times over. And that's why, because we don't have the same fail fast, fail forward luxury, if you will. But it's still, until we convert and I'm really a bit unfortunately, until we convert the lip service to actual allocation, we're not going to see the change. Someone has to take the first plunge. Somebody has to, bring it to life. And the female conversation is not just a women conversation. It's the male allies we have who will start, walking alongside us to make this happen.
Yeah, and I'll just put one compliment to Hema's point. I agree with her 100%. Ultimately, capitalism rules. And at the end of the day, I can tell you as somebody who has 40% of my portfolio in women, we're kicking butt backing women. And what's going to happen is people generally don't like to lead. They don't want to be the nail that sticks up. And so as they watch people like Hema and us and others make a lot of money as capitalists backing women for no altruistic reason, but for purely capitalistic reasons, they will follow because money likes to make money. And so over time, this will get resolved because the proof is now out there and you can't put it back in the bottle.
One more comment on that one. I think on a sort of human level, it's a total travesty that 3% of the money flows to women founders. On an investment level, that's an excellent opportunity. So we look particularly for underserved opportunities, meaning geographically. We look at the Midwest, Canada, the South, parts of Eastern Europe, where we think there's less venture capital. We do the same for women-led companies. The valuations are probably like for like lower and the quality better. And we do it for minorities as well. I think a similar trend, that I don't have the numbers in front of me, but a similar trend holds as well. So it's an excellent opportunity, I think, for any asset class, but particularly for private growth venture.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.